Good afternoon, everyone. Thank you for joining us. I'm going to take a few seconds to share my screen and give you an overview of what we've got going on today. There we go. Again, good afternoon, everyone. My name is Lauren Simpson. I'm with the SBDC, or the Small Business Development Center. We're a national program with over 1,000 locations across the country. So regardless of what state you might be in, your city or neighboring city should have an SBDC office where you can tap into our resources. And you'll want to do so because we offer no-cost services for local small businesses, and they're at no cost because your federal dollars have already taken care of our fees. So please get in contact with us. We'd love to work with you. For the Los Angeles network, which is the network that I represent, we serve small businesses throughout Los Angeles, Santa Barbara, and Ventura counties. And in front of you, you'll see a map of our locations. And again, we offer no cost business advising. And so you're able to get in contact with financial experts such as Mike DiDonato, my colleague here today, as well as GB Bajaj, who has joined us as well as other business experts who have expertise in marketing, as well as drafting business plans, attaining licenses and permits, whatever it is your small business might need, we have resources for you. So be sure to get in contact with us. And again, we offer virtual trainings, much like the training you have logged into today. I keep saying get in contact with us. Well, here's our contact information. You can reach us at 866-588-7232 or online, smallbizla.org/new client. Or you can see, if for those of you, who have joined us outside of the Los Angeles network, you can contact us at America's SBDC /find your SBDC. And then really quickly, before I hand it over to the gentleman, we have the California Dream Fund going on. And so the pilot program begins next week. And the full program will be coming online in June. So please be sure to log on to smallbizla.org/dream fund. Be sure to fill out the registration form. Let's see what else. Be sure to sign up for one of our tracks. And so on that registration form, you'll see various genres of industries. Notate your industry, and then we'll be sure that you receive information related to that track. Let's see with that. Quick housekeeping, be sure to put any questions into our Q&A. Again, questions for the Q&A, and then I'll be sure to list links, Mike, into the chat. So I'll link our Dream Fund landing page into that chat, as well as contact for you and for GB. So those of you who want to get in contact with them, please be sure to check the chat. Thank you.
Also, Lauren, please put into the chat room the link to the new client portal if somebody wants to join us. Okay. Put all your questions in Q&A, and please direct the questions to the specific topic we're going to cover today. If your question is related to a topic that's not related to what we're doing, we will refer you to an SBDC advisor, and you should all be going to one-on-ones with SBDC advisors anyway. GB Bajaj is trying to connect in with us. I think he's having some connection issues. He was going to cover financial ratios as he started last week. If GB cannot hear me right now, I don't believe, because it says he's connecting to audio. So what I will do is I will start a presentation on legal structure and regulatory filings as GB is having these issues. So let me go ahead and share my screen. Thank you for joining us today. Appreciate it. What you see on the screen is a presentation I do on a workshop on legal structures and regulatory filings. GB, are you with us? You are. I'll stop the share. Hi, GB, you're muted.
Let's see.
We can hear you now. Nope, now you're muted again. There we go.
What about now?
We're good.
Okay, good. Good, good, good. I upgraded my Zoom app, and all of a sudden it just stopped working.
Understood. So did you get some sleep after April 18th?
I did, and I'm noticing again, you and I were both wearing blue again, Mike.
Oh, and we didn't coordinate this. Yes, that's true.
We did not coordinate. It's just, what can I say?
So GB, I was saying that
you were, today.
Sure, you were going to continue on the financial ratio analysis, right? Today?
That is correct. Yes.
So why don't we do that?
That is correct, and I'm just, yes, sir. Just give me a moment.
Sure.
And here we go. Let me know if you see my screen in just a moment.
Mm-hmm.
3, 2.
Yes.
Can you see my screen?
Yes,
perfect.
We got it. We're good.
And last week, I believe we left off on the working capital ratio, I believe,
Yep.
or the cash ratio, I think.
We talked about
right?
cash ratios. Yep. Mm-hmm.
Okay. And did we or did we not talk about the quick cash ratio?
You covered the quick cash ratio. That you covered.
Okay, perfect. Okay. So today we're going to talk about, to continue on. Actually, before I do, Mike, anything you want to add, any questions that may have come in that we need to address before we do the financial analysis equations?
No, there's no questions that have come up. What I'd say is that people should pay close attention to this, because it's not just history that you want to look at. You want to look at projections. So by doing this type of work, you can also project out into the future, and budgeting is critical. So please continue.
Correct. Perfect. So one of the other equations that I encourage myself and my clients to look at is a cash flow to debt ratio. It gives my lenders comfort knowing that if I win the lottery or if I retire, do I have enough cash to retire all my obligations or not? Because generally speaking, even when people have a financial windfall or they have a change of heart and they want to exit business, very few, unless there's a financial or legal trouble, very few just close doors immediately. There are operations that have to be wound down. Even the state of California and many other states will not allow you to dissolve your entity until and unless you certify and prove, depending upon the scope of your business, that you have satisfied all of your outstanding obligations, whether it is through payoff or through bankruptcy. So the cash flow to debt ratio allows the lender to see that if the business were to wind down eventually, or if the business had nothing better to do with this money, then how long will it take for the business operations cash flow to pay off and retire all of his debt obligations? So for this ratio, we look at both the income statement and we take a look at the balance sheet. So we start off with the income statement and we take a look at the total operating income. And in this case, the operating income will be on here, that the operating income in this case is $39,000 for this company. And let me just double check. Net income, total non-operating. Okay, so from the operations, we take a look at that the gross profit is $370,000. That is a gross profit. And the total expenses are $170,000 over here. We're not counting this, actually, no, not 170. It's 321,000 minus $9,000. So 321 minus $9,000 is $312,000. So this company has the operating income, the equal sign, of this minus this, $58,000. So that is its operating income for the year. And when we go to the balance sheet, we take a look at all of their liabilities. Their total liabilities are $481,000. So we just put that somewhere, $481,000. Now to look at this ratio of the cash flow to debt ratio, we take the total operating income, which is $58,000, and we divide it by the debt. So if you do another formula, we take 58,000, we divide that by 481,000, it gives us 0.12. So which means every year, if I do the, so let's say 12%, 12% is the ratio. So if this company were to use its operations to pay off its debt, it will take approximately 8 years, 8 to 8.5 years. And the way I got it is 100% divided by 12 gives us, oh, I didn't put the formula. 100 divided by 12 gives me 8.33. So if the business were to take all of its money that it makes every year from operations without counting in the loss on land and the interest expense, it will take this company 8 years to pay off all of its obligations. And now, why is that helpful? You win the lottery and you don't need the money anymore. You take all of the business operations, pay for all of the expenses. The company can wind up its operations in about 8 years if it relies only on the operation. Can you go in, use your own money to pay off the obligation to wind down the business sooner? Absolutely. So this is where sometimes when I work with my clients and they just want to retire early, do this calculation to say, okay, do you want to keep this business running and eventually wind itself off, or do you want to use your personal capital and pay off the obligation? Now, why is that important? It's a liability. The liability is, as long as a business is operating, you are the shareholder, you're filing taxes, you're still fulfilling all of the obligations. If you have a lot of assets to protect, maybe it is in your best interest to wind down the business by using your own investment. So what is the right answer? It depends upon the financial picture and the legal exposure of a certain individual or individuals and the exposure of the business. Mike, does that help? And would you like to add something to it?
Could you just move the Excel spreadsheet aside so we can see the balance sheet?
Absolutely. Let me move that.
Thank you.
Go ahead.
All right, thank
Sure.
you. So these liabilities are legal obligations. So if somebody has a thought that they're going to be able to escape paying these, that's not the right thought.
It depends.
Well,
it depends.
You have notes payable, you have accounts payable. You might be able to negotiate some of those things, right?
Correct.
You might be able to get a discount on some of those things. Go ahead, GB.
So this is where it's a very good question that people bring up, that can I escape these liabilities if I were to wind my business down? Because we're told, get a corporation, get an LLC so you can protect your personal liability from the business liability. It is all true if the terms of the note and the terms of the accounts payable allow for that. Most attendees of these webinars are small business owners. You may have personal obligation to your business liabilities, even though you have a corporation, even though you have an LLC. Typically, most lenders and most vendors do not absolve an individual or individuals of personal liability until and unless the business has at least $10 million in revenue. Once you reach $10 million in revenue, you are now barely a mid-sized business. Anything below 10 million is usually considered a small business. Or if the business has enough assets, that it has enough land, has enough equipment, that the lender feels comfortable that if the business were to dissolve voluntarily or involuntarily, they can use the business assets to satisfy the obligation. If that is not the case, usually personal guarantee is required. This is why many of us who receive PPP, EIDL, and other SBA loans, they usually require a personal guarantee. So, and even lease agreements, most landlords, when they lease property to a small business owner, they usually look for a personal guarantee. So if you have a lease obligation on there and you owe money because maybe during the pandemic you didn't pay the rent, it was deferred, it may be a rent payable liability on your balance sheet. If you decide to wind business down, depending upon your lease agreement, you may or may not be held liable. So the devil and the opportunity is in details. And Mike, with your legal expertise, would you say that is the case?
That is correct. Which means you need to understand the language in anything that you sign, as always, including any anything you sign associated with vendors. They often oftentimes have personal guarantees too. With regards to wages payable, that's one you can't escape. That's the one that the state of California takes very seriously. You have to pay your people.
And IRS.
Oh, right.
Exactly. Yeah, especially, and I'm glad you bring it up, especially as you can see, there's taxes payable as well, depending upon if that tax is income tax, or if it is the payroll tax, or if it is the sales and use tax. Sales and use tax, the state of California will not issue you a sales tax permit unless you or someone in your office takes personal liability. It could be you as a business owner, it could be your office manager, it could be your cleaning lady. Any person who signs that permit is liable. So it doesn't matter if you have a corporation or you have an LLC, sales tax, payroll tax, somebody has to take the personal guarantee. IRS will not allow you to run payroll. California will not issue you a payroll tax account unless someone takes personal liability. Doesn't matter if you have a corporation or an LLC. So thank you, Mike, for bringing that up. You do that, and you cannot bankrupt those things.
Right. That's exactly true. That you are actually you're criminally liable if you don't pay your wages.
Indeed. You can go to prison for that, because these are considered payroll taxes, sales and use tax. These are considered trust fund taxes. The consumer, the employee, and the US government and the state government are trusting you, somebody in your business, that if something goes wrong, guess what? They're coming after you personally. Your home, your retirement account, your future income. So you may be broke today if you make any money, or your spouse may be even, because we live in community property state. There could also be extended liability there. So this is why this ratio is helpful, because just like with the quick cash ratio, if you want to understand, okay, if I'm going to wind down my business in a year or 2 years, you want to take a look at your liabilities, take a look at your ratio and say, okay, whom am I going to pay off first? Where do I have the personal liability? And proceed accordingly.
Thank you. Please continue.
Thank you. So not only are these ratios important for financial analysis, but also for legal exposure, and know what contracts you're signing. So that's one takeaway I would suggest from all of this. Then the next ratio that we talked about previously was the debt service coverage ratio. And this is one ratio that SBA will definitely take a look at before they will extend any loan to you. And Mike, do you even know how many times a client walks in and says, GB, or says, Mike, I want a loan, and you take a look at the debt service coverage ratio, like, nobody, you're not getting any loan.
No,
how often does that happen?
Quite often. It's just not going to happen.
Yeah.
Yeah.
People have this impression that if it's SBA loan, they have to issue that loan. People that sometimes clients from SBDC and my friends, well, it's SBA, they have to issue the loan. No, they don't.
No.
They don't have
so let me address that
it's not
briefly.
a good risk.
The SBA wants to be sure you have collateral. You have the ability, capacity to pay back the loan. You can carry the debt service that you're talking about.
Right.
You have to have a good credit score, right? And you have to have skin in the game. You have to have a viable business, right?
Indeed.
It has to be. If you don't meet those qualifications, you will not get an SBA back loan. But the SBA will. Go ahead.
Yes, I would say the only exception we saw was the EIDL when the pandemic hit.
Right, and that's an extreme case.
Yeah.
So please continue.
You're right. Thank you. So basically, the debt service ratio looks at that the amount of debt that you currently have and the amount of debt that you are seeking, maybe the future one, does your business operating income is positive enough to cover the monthly payment? If it is not, it's not going to issue you the loan, because if everything is said and done and you have $1,000 to your name, not even to your name, to your business's name, and your monthly payment is $1,500, SBA will not issue the loan. So how do we look at that? We take a look at the net operating income. So in this case, if I bring my Excel back, we go to, so remember we did the calculation, $58,000 is our net operating income. And then we look at our total debt payments for that, let's say for that year. So on our income statement, if we take a look at actually this one doesn't say, maybe loss on the land.
No, the debt payments would be
Revenue.
a portion of the liability paid against the, against the notes payable.
Exactly. So that would be a combination again, because you may have the interest expense, like for example here, $7,000, and then you also have all of these liabilities that may have different payback schedule. Some of these bonds may have a 30-year schedule, and the notes may have a 5-year. So let's assume, let's say for discussion's sake, let's say the total obligations are maybe
We can't see a spreadsheet.
$5,000 a month. Okay.
Can you put a spreadsheet on the screen?
Can you see it now?
Yes.
Perfect. So let's say, so we figured that our operating income is $58,000. Let's say our clients, their monthly payment for all their obligations, maybe they have a business truck, maybe they have a business loan, they have EIDL, maybe part of their PPP was not forgiven, maybe they also owe money to Uncle Sam and to franchise. I mean, let's say all of that, when said and done, their total monthly obligations are $5,000. So $5,000 per month times 12 is $60,000. So let's say $60,000 is their total obligation. So if you take a look at the ratio, we're going to say equal to the operating income, the net operating income, divide that by the total debt payments for the year, you get a ratio of 0.9666, which means at the present moment, your operating income can only service up to 96% of its obligation, which means you're 4% short. And if maybe you're putting money back into the business to make those debt payments, but if you apply for another SBA loan, does that mean it's a guaranteed automatic no?
No.
Doesn't have to be, because we can show perhaps, okay, right now your obligations are $60,000, but if you were to get this loan from the SBA, maybe the interest rate would be much more attractive. Right now, maybe you're paying 29%, maybe you were late on a few credit card payments. And let's say we tell the SBA, based upon your financials, that these are your fixed obligations, we cannot negotiate them, but these are the obligations that we can negotiate. And if the SBA gives you the loan, you will not use it personally, but you will use it to pay off some high interest loan. Let's say if it turns out to be $48,000, that is your new payment. Well, now your debt to coverage ratio, your debt service coverage ratio is 1.2% or 1.21%. So which means you go from a negative 4% to a positive 21%, which means everything else being equal, SBA may be willing to lend you even more money so you can expand your operations and further optimize your business. Mike, what would you say on that?
You're right. Two caveats. The SBA does not lend directly except in extreme circumstances like disaster loans. They lend through lenders. Yes. So you have to go to an approved SBA lender.
Indeed.
And they also still look at credit scores. Your personal credit score plays a role in this. And it used to be 680 or higher in order to get a loan, an SBA-backed loan. Exactly. That may have changed recently.
Sometimes they won't even, exactly. And they may not even give you the money directly. Sometimes they pay your vendors directly, or sometimes they will just use that money to pay off a debt obligation because they don't want you to promise them, I'll pay off this obligation, and then you don't. So they also control the means of distribution of that cash.
Yeah, we should probably do a workshop just on SBA loans, the different SBA loans, GB.
Yeah, okay. Absolutely. There are different types of loans or different requirements and different collateral. So the point is, periodically, look at your debt service coverage ratio and shop around. a good CFO engages in what's called financial engineering, that maybe they can raise money from friends, family, or other angel investors, or if you're big enough, venture capitalists, that, hey, give us the money, we will retire this debt and use that money to give you a return on investment. So you always want to take a look at your debt service coverage ratio. Maybe you had poor credit a few months ago, a few years ago, now your credit is better. If the lending is attractive, a lot of people, it's no different than when interest rates were really low a year ago, people refinance their homes. Say, hey, I'm paying 3.5%, 4%, now I can get 2%. You want to take a very similar view of your business. And sometimes a loan option that may be close to you today may be open tomorrow because maybe your operation improves, maybe you cut costs, whatever the case may be. Maybe you automate, you lay people off, you cut your rental expense, whatever you have to do to cut your expenses, your operating income goes up, your debt service coverage ratio improves. It makes you more marketable because you're now much more attractive to existing or a potential lender. As Mike has brought it up so many times, that each loan that you take on at times has covenants. If your debt service coverage ratio deteriorates, the loan may be called in. So before they run the numbers for you, you want to watch your financials. Also, on the flip side, if it improves, you may want to contact your lender and say, hey, I want you to renegotiate my debt and give me better rates. Again, it's no different than when people buy a home with less than 20% down payment. They usually end up with a PMI, private mortgage insurance. Depending upon what loan you have, sometimes if your equity in the home improves because the market is going crazy, the PMI will drop off if you request it. And sometimes they say, well, no, your debt to equity ratio has to go back to the original loan before the PMI will come off. And PMI, private mortgage insurance, can be very expensive. So watch your debt service coverage ratio to make sure, A, you do not violate any of the covenants of your loans, and B, if you are doing better than expected, negotiate, negotiate, negotiate. Anything you would like to add to that, Mike?
Yeah, very quickly before you move on, for those of you who took EIDL loans, or any loan for that matter, look at the verbiage in the promissory notes that you signed. There are certain actions you cannot take without written approval from the SBA or your lender. So if you want to change your location, if you want to shut it down, if you want to buy other equipment, possibly, depending on how much you're buying, you need to double check the verbiage to get written approval. If you want to take another loan, you might have to get written approval. All right, GB, please continue.
Absolutely. Thank you, sir. Absolutely. The devil and the opportunity is in the details. Okay, so most of the ratios that we have looked at so far today and last week have been an interaction between the income statement and the balance sheet. Now I'm going to take a look at some of the ratios that are very common, but a lot of people ignore because they think, oh, I'm too small to take a look at it. And maybe you are, but you have to ask yourself, do you always want to be small? Or if you want to grow, how much do you want to grow? Because if you want to grow, then these are some of the ratios that you want to monitor from time to time and tweak with them, because they allow you to market your business to potential vendors and investors and anybody else who has a stake in your business. So some of these ratios are, let me clear these out first. Some of these ratios, as you may have heard of this very common one, debt to equity ratio. Debt to equity ratio is basically that how much of your liability, what percentage of your equity is your liability? That is your business growing mostly out of liabilities, or is it growing mostly out of equity? And each one has its pros and cons, and we'll take a look at it in just a moment. So the debt to equity ratio, you take a look at your total liabilities and you divide it by your total equity. So in this case, the example that we have on the screen, now this is one of those ratios that is purely balance sheet oriented. So the total, in this example, for this company, the total liabilities are right here, $481,000. And their total equity is $289,000. So if we take a ratio of that, the ratio is dividing the total liabilities, in this case, total liabilities, and you divide that by the total equity, that gives you 166%, so 1.66. So let's just say, in this case, they are 66, sorry, Mike, did you say something? Oh, sorry, I thought you were saying something. Okay, so in this case, the liability is 1.6 times their equity in the business. So this is a very debt-heavy business compared to the equity. Is that a good thing or a bad thing? We don't know. Just because one simple ratio doesn't tell us anything. We have to track this ratio over time, because sometimes, as we said last time, a lot of people who took the PPP money and the EIDL money, this ratio would have said that, yes, your debt is growing much faster than your equity is. And your equity is not just your skin in the game, because if you take a look at this balance sheet, we have common stock, we have retained earnings, and we have, well, let's just forget the treasury stock, because treasury stock is usually for a public company, but we have common stock and retained earnings. So that is your total skin in the game. How much money did you put in and how much money is left over? Because the retained earnings are basically that whatever money your company made, how much of that money is being retained within the business. Now, retained earnings are treated differently if you are a C Corp versus if you are an S Corp. Because a C Corp, if it makes any and all of its money, it can just say, hey, I'm going to hold on to it. And it will pay taxes by itself on its earnings, but the shareholders will pay nothing. Whereas in an S corporation, the company may retain earnings. The company may say, well, you know what? I have an S Corp. We made $100,000. I'm going to hold on to it. But the shareholder still has to pay taxes on that $100,000. So this is where, if you own an S corporation, you have to ask yourself, how much of your earnings are you going to retain in your business, and how much are you going to distribute to yourself? Because either way, the amount is being reported on your K-1 as taxable income, depending upon what income bracket you're in. So the retained earnings are also treated differently for S corporation versus C Corp. So depending upon your business is growing or contracting, one single ratio doesn't tell you anything, but over time, you can see that is your equity, your skin in the game, is it improving, or is your debt increasing? So the example I use with many of my clients, imagine you buy a home for $1 million and you give $200,000 down. Your equity in the business, in your home, is $200,000 and your debt is $800,000. So your debt to equity ratio is, in that case, 4. So your debt is 4 times your skin in the game. Now, is it a good thing or a bad thing? Well, we don't know. Because if the market improves tomorrow and now your home is worth $1.2 million and you haven't really paid off any debt, let's say only interest payments, well, now your equity has increased in the business, in your home, but your debt hasn't. So just on a paper, you are doing better than most other people. But if the market crashes and now your home is worth less, and let's say now your home is worth $800,000, you owe $800,000, you have no equity in that home. If there is a sneeze in your finances, you could lose that home, because now the bank is worried that you have no skin in the game and they're the only ones holding any value in your home. Your employees, your government, your vendors, your lenders, all of them look at your finances and say, hey, if you have no equity in the business, you're not putting any money in your business to grow, and your business is losing money, your equity is dropping, but your debt is going up, they're worried. They're worried that you have no skin in the game and your debt is growing. How will you pay it off? then they may take a look at your other ratios, such as the cash to debt ratio, the debt service coverage ratio. But basically, at that moment, everybody else is making money in your business but you, because you have no skin in the game. You don't have any money in, and you have no retained earnings. So your business can grow in one of two ways. Look at many, for example, Uber. It doesn't have much retained earnings, relatively speaking, but people are still putting money into it because they believe it's a good idea. Same thing with many of these unicorns that we hear about on Wall Street. So you have to take a look at your business plan and understand how long can your business survive with using other people's money, whether it's liabilities or whether it's common stock coming from yourself or others. Mike, does that make sense? And would you like to add something to it?
No, that was perfectly explained. What you're driving at is the equity that you have in your business is critical to the financial health of your business. And so what I have seen too many times, you've probably seen, is that people stripping these earnings out and leaving nothing in the business, or very little. And then when they go to apply for a loan, for example, they get denied, and they say, but wait a minute, I'm generating enough income. But no, you haven't left anything in the business, you're stripping it.
Exactly. That's a very good point, Mike. That's very well put, that you need to leave enough money in your business to allow your stakeholders to feel comfortable that, you know what, they are leaving money in, I should leave my money in too. If you're stripping all the earnings, as Mike mentioned, the lenders may say, hey, maybe I should get my money out too, because what if the business shuts down tomorrow, voluntarily or involuntarily? So I know many of my clients who are doing very well, they always leave at least 20 to 30% of the earnings in the business so that their equity is always growing, and they can show to the lenders and their employees that, hey, I'm also putting money in. It's not just you.
That's a good rule of thumb. 20 to 30% left in the business is a good rule of thumb to go by. Yeah.
Thank you, sir. So then the next ratio that we take a look at is the debt to asset ratio. That if all of your assets in the business, how much of that is debt and how much of it is your assets. So it's different from the equity, because now we're no longer looking at how much is your money in. We're just taking a look at, given this asset in a business, how much debt you have on it and what percentages it is, and is it growing or is it deteriorating? So in this case, we take a look at your total liabilities, which we saw is $481,000. And then we take a look at your total assets. Now, this is where, depending upon how big or small your business is, you want to be mindful of what asset you're looking at. And you may want to make an adjustment. In a typical public company, we take a look at all of their assets, their current assets, their investments, their PPE, which is a property, plant, equipment. We take a look at their intangible assets, the number one being goodwill and trade name. And it's intangible because here today, it could be gone tomorrow. It's brand image, it's public relations. So in this case, let's say $770,000. So we have the total liabilities of still $481,000. And then we have the total assets of $770,000. And to get the ratio, we say, okay, the debt to total assets, 481 divided by 770 gives us 0.62, which means this company has 38%. The company has of all their assets, 62% is in debt and 38% is their appreciation in it. Now, what is good, what is bad? This can also change. If the value of your asset improves, so let's say maybe the value of your land improves, in your books, you will not change it, because under GAAP, if your books are created using GAAP, we always track everything based upon the historical value. So in that case, if some of my clients need to maintain the covenants of the loan, then we take a look at, okay, how can we get that money out of that appreciating asset? So let's say maybe your building, you bought it for $180,000, maybe 10 years ago, and now it's worth $480,000, maybe $580,000. Then the discussion becomes, okay, if you don't have enough debt should you take more debt so you can use that $400,000 and put it to a better use? Usually, the rule of thumb is you don't want your, generally speaking, you don't want your ratio to be more than 80%. Beyond 80%, you may be deemed to be over leveraged. Now, sometimes it's not a bad thing. Some of the larger companies, some of the mid-sized companies, sometimes they will keep the debt to asset ratios even higher because they want to mitigate someone suing them for taking over their asset. So what is right, what is not right, it all depends upon your business plan, your comparative market space, but usually the rule of thumb is you want the debt to asset ratio to be around 0.8 or 80%. That 20% of equity is there, or not 20% equity, 20% of the value of the asset is there should there be any bad times. But now I'm actually working with a client, their ratio is only 25%. So they're not fully utilizing their balance sheet because they have so many of the appreciating assets sitting in their business, and they have great business ideas. So my conversation with them right now is maybe pulling some of that asset value out, increasing your debt position so you can use that money to further enhance your business and make more money. What would you say to that, Mike?
Makes perfect sense to me. However, there's a caution in regards to liquidated value. So is that inventory really worth $31,000 as a spot? You see what I'm saying?
Correct.
And but on the other hand,
so
what you see here is the land, I'm assuming, is at historical cost, right?
Exactly. Yes. Under GAAP, we always track historical cost.
So you might have to recast these numbers depending on what you want to do.
Correct. Absolutely. And this is where there's something called mark to market. Sometimes that happens where you say, okay, oil. We saw oil drop significantly, and US has inventory of oil, and many of these oil companies carry it. In their case, the inventory value increased dramatically. Whereas if you have computer components, with time, usually those components, they become obsolete and lose value. So mark to market is important as you are making these financial decisions, because under GAAP, which is generally accepted accounting principles, you are not supposed to change the historical value of your assets and your liabilities, but you can always engineer them to get value out of your company. If your company has assets that have really appreciated, especially if you are investing in real estate, you may want to pull that equity out so that you can further leverage it. Now, the caveat there is everybody has a different threshold. There are people who will bet the whole 9 yards every roll of the dice, no problem. And then others who are much more conservative. So numbers only tell the story based upon what story you want to tell. Do not over leverage yourself if you cannot sleep at night. But also under leverage can also hurt you because somebody else may make better deals than you can because you are cash constrained. A lot of times I come across my clients who are asset rich but cash poor. So sometimes looking at these debt to asset ratio, we can pull some of the money out of the assets to make them cash rich. And now cash is king, and they can make decisions that a month ago, 3 months ago, they were unable to make. So all of this stuff, again, is never taken in a vacuum. It's looked at over time, given your emotional intelligence and given your risk tolerance. Would you agree on that, Mike?
Yep, makes perfect sense to me. Why don't we continue on? Do you have one or two other examples?
Yes. Yes, actually, let's do one more today. Return on equity. Now, this is a big one. This is what everybody wants to take a look at, that if I put money into your company, what are you promising me? And whatever you're promising me, do your financials support that or not? So this is where we take a look at the historical trend. So for example, in this company's case, we go back to interaction between the income statement and the balance sheet one more time. we take a look at what is your net income. In this case, it's $39,000. That is your net profit from the business of $39,000. And then what is your shareholders' equity? In this case, the total shareholders' equity is $289,000. So what is the ROI? The ROI in this case will be 39,000 divided by 289,000. Let's say multiply that by 100. 13.49%. Is it good? I don't know. You tell me. If you know there's a better investment out there that's giving you, I mean, S&P 500, we hear that, right? Over time, it gives you 7 or 8%. This is giving you 13.5%. Now, how do you analyze that? One of the quick and dirty ratio or calculation that people look at is a rule of 72. Rule of 72 basically says how long will it take you to double your money? So in looking at the ROI, so if you take 72, divide that by this number, about 5 years. So what that tells you, if you put $10,000 in this business, in 5 years, you will double your money. If you think that's a good idea, why not? And this is where, again, we don't take a look at this in vacuum. We take a look at it over time. That over time is the return on equity increasing or decreasing? Because maybe it's great. Maybe you would have doubled your money if you put your money in this business last year. But if now the money is deteriorating, you don't want to. So the ROI does not exist in a vacuum, and you want to use it to understand, hey, if you're doubling your money in your business, why would you want to buy S&P 500? Because let's say if the S&P 500 doubles, or not doubles, let's say gives you 7% return on equity, you will double your money in 10 years. So which means your business is better than most of the businesses out there on average. So you have a great idea. Don't go putting money into something else, the S&P 500 or ETF. You may want to invest here. So the return on equity, especially with the rule of 72, allows you to compare returns and say, how long does it take you to double your money? And who doesn't want to double your money? But remember, be reasonable, be fair. Whatever happened in the past doesn't mean it will happen in the future. And also, maybe you just got a great new patent, or you got a great new idea, or a great new worker, and you can also use these numbers to tell the story that, listen, look at my business. For the last 5 years, if we're giving more than 12% return on investment, with this new idea, this new franchise, this new whatever, I will make even more. So maybe now I'm projecting my ROI will be 16%. So if that's the case, at 16%, you know what? I will double your money in 4.5 years, as opposed to 5.3 years. So return on investment is a great tool to understand also if your business is growing or contracting. It's also a good way to understand, does your business have enough of its own, of your money in it or not? So these ratios, these numbers by themselves do not tell you anything, but taken together, it gives you a pulse on your business. Are you doing well? Are you doing poorly? Where can you improve? Are you being risk averse? Are you being too much of a risk taker? And numbers will tell you all of this, because from a day-to-day management, you may not be able to. And something else I suggest to my clients, maybe have somebody else in your business, in your family, run these numbers for you. It could be a spouse, it could be a child, it could be a parent. Because I sometimes can be blinded by my own ambition. I can be blinded by my own rosy stories that I may tell myself. Maybe my spouse or my father can say, you know what, son, I'm looking at your numbers. It's not looking so good. Or I'm looking at your numbers, you are short selling yourself. Maybe you should double down on yourself, or maybe you should go out there and allow others to make money with you, because you have a great idea here. What I have noticed with myself, having somebody else run these equations, these ratios for me, makes them a great advisor for me. And I know some of us at the SBDC do this for our clients, where we run these numbers for them, and then it's a much more fruitful discussion as opposed to, hey, it sounds like you have a good idea. Mike, do you ever run these financial analysis with your clients at SBDC?
I have run financial analysis. Oftentimes we're dealing with startups, so they don't have a history. But for those who do have a history,
Correct.
we'll do this. What I'm going to recommend is that people become, you can look up these ratios. Look up key financial ratios,
Correct.
Google, and you'll find them. Run them. I mean, I think you're using QuickBooks or some other bookkeeping service here. You can
Correct.
actually calculate it with the software. You don't have to manually calculate it like
Indeed.
you're doing here. And run it for a
Correct.
period of time, and then
Correct.
look at it once a month, once a quarter, once a
Yeah.
year.
Yeah.
Right? We didn't
Absolutely.
address a couple ones. One key one we didn't address is accounts receivable,
Sure.
receivable aging, days sales receivable, days sales outstanding, DSO.
Correct.
So there's a few other key
Yeah.
ratios.
That was a little hard to look at usually.
Yeah.
That's in a webinar setting, because you have to take a look at all the accounts receivables. And Mike, do you want to share, like, what do those ratios usually tell the business owner?
Okay, so for those of you who are carrying receivables, and not everybody does, if you're a cash business, you won't have a receivable. Something called days sales outstanding tells you how quickly somebody pays you. You might want 30-day terms. You might be getting 45 paid in 45 days, but the ratio calculation will tell you exactly how quickly you're getting that money in. And if you see that expand out month over month over month, then you know there's a problem with your people paying you. There's also something called days payable outstanding, which determines how quickly you're paying others. So if your days sales outstanding is expanding, but your days payable is contracting, now we have a gap, right? Because you're not matching your receivable collections with your payables that are going out the door. So those are two calculations I think are critical. I realize you don't have time to go through all these ratios. There's a whole host of ratios.
Correct. Indeed.
What do you say about that?
And I'm guilty of that. Over the last 2 years, my business grew, and I got so busy that I got delayed in invoicing people. So even though I was extending them a certain time, and it was like, I know I love you, I trust you, but next thing you know, like, shoot, it's been a long time. So the accounts receivable also allows you to be honest with yourself and say, you know what, maybe I'm too busy now. I need to have somebody else take over this responsibility to either A, invoice clients, or B, collect, because people also forget to pay you sometimes. So you're right. You don't want to run into a cash crunch where people are not paying you because they're not being reminded. And depending upon what industry you're in, some industries are more prone to AR, accounts receivable issues. So if you are in that industry, you may want to have somebody pre-designated to collect receivables. Also, if you ever use a collection agency, they want to take a look at those ratios. So what is the issue here? Are you just bad at collecting, or do you have bad clients? Or because if it's a collection agency, depending upon what you negotiate with them, if they're buying those receivables from you, or if they are just collecting for you, all of these are decisions not to be made in a vacuum. But all these ratios, as Mike, you brought it up, are crucial and critical in understanding your business and where you can improve and where you should stop doing something and hire somebody if necessary.
Now, we can help you set up a model. There's lots of models out there to help you calculate these ratios and keep track of it. So once again, best thing you do is talk to a financial advisor, make an appointment with an SBDC advisor, talk to your tax professional. They can often help you build these models. And once it's built, it's built. You're just clicking a button and you can run it. Right, GB?
Correct.
Yeah.
Absolutely. So with your permission, Mike, next week, let's not do ratios because too much math can be boring. So we did ratios for 2 weeks. So I don't know what I'm going to talk about next week yet, but
how about the SBA?
Topic.
How about the SBA loans? We're getting a lot of questions about SBA loans.
The SBA loan? Okay, sure. Let's do that. I'll do the SBA loans, more specifically the EIDL, I would say, right? Or just overall in general, all the different SBA loans.
Why don't we go over the 7A and 504 loans and to discuss the differences between the two of those, et cetera. Okay. Cool.
Perfect. Let's do that. So perfect.
All right, great. Lauren, thank you
A
so
lot
much.
of math. Thank you for.
Yeah, I know, but
Sorry,
once the math is set up, it's what you do with the math.
Exactly.
Right? All right, thanks, Lauren. Thanks, GB. Everyone have a good weekend.
Thank you, Mike. Thank you, Lauren.
Bye.